Hello everyone and welcome back to the course. In this video or in this lecture, we're going to be learning what Forex trading is all about, or what Forex is about. So you've probably have heard of the word Forex or Forex trading in the past and wondered what Forex is all about. Maybe you even have friends that trade the Forex market, or you've heard of someone who trades the Forex market and you've heard them say maybe they've made money trading Forex, or they make money trading Forex, and wondered what Forex trading is all about. In this video, we're going to try our best to explain that in basic terms what Forex trading is about. So to the big question now, what is Forex? What is Forex? So as you can see on my screen right now, Forex is gotten from two words: foreign exchange. For, that's FOR, to stand for foreign, and then EX to stand for exchange. So that's what Forex, that's what the term Forex stands for. And Forex, and foreign exchange or Forex is the conversion of one country's currency into another country's currency. That's basically it, the conversion of one country's currency into another country's currency. So if you've ever converted your country's currency into another country's currency, whether for traveling purposes, maybe you're going on a vacation or you're traveling to visit a friend, okay, outside the country, or maybe for the purpose of purchasing some items from that country, or for whatever purpose or reason, then you've participated in Forex trading without even knowing it, okay, because you've exchanged one country's currency into another country's currency. Now, the Forex market is by far the largest market in the world, with more than $5 trillion traded on a single day. And this Forex market is larger than the stock market and the cryptocurrency market combined. Okay, the market is a 24-hour market that it goes on for 24 hours in a day and for 5 days in a week. So these are some of the things you need to know about the Forex market. Okay, now the conversion rate between two currencies is never constant, and that's why it's possible that you converted, let's say you converted the US dollars to euro maybe today, and you got it at a conversion rate of $1.07 to 1 euro, just an example. And then you come back maybe after a week and then try to convert the same dollar to euro, and then you see that the conversion rate is no longer $1.07 to 1 euro. Let's say it's now $1.1 to 1 euro. Okay, so you've probably encountered a situation like this. Probably if you've exchanged the currency or your country's currency to another country's currency or multiple times, or if you've basically participated in Forex, like I just explained earlier. So you've probably encountered this phenomenon whereby the conversion rates of this currency into the other currency is not constant. So it's never constant, okay? And then even though the movements are minute, are very little most of the time, it's still not constant. Now, these constant changes in the exchange rates of one country's currency into another country's currency are caused by the activities of the Forex market, okay? And also the principles of economics, the principles of supply and demand, okay? And as professional Forex traders, we take advantage of these changes to make profit in the market. So that's basically how we make money in the Forex market. We take advantages of the changes in prices of exchange rates between two currencies, okay? Between one currency and another currency as professional Forex traders. And of course, that's the purpose of this course, to introduce you to the Forex market and ultimately teach you how to make consistent profit in the Forex market. Now, some of you might be asking, but how do we actually make profit, or how do we actually make money with these changes in the Forex market? So this is actually pretty simple. Okay, so we make money in Forex trading by buying a currency when it's low and selling it when it's high. That's basically it. Just buy a currency when it's low and sell it when it's high. You're going to make a profit. When you buy a currency when it's low and sell it when it's high, the difference between the two prices you bought and sold is your profit. Okay, it's basically like, let's say you buy Jordans, or you buy a shoe. You buy it at a wholesale price, maybe from a wholesale dealer, and then you sell it to a retail consumer. Okay, of course, you are not going to sell it at the price you bought it. Okay, you are buying it from a wholesale dealer, or let's say the manufacturer even. So you buy it at a very low price, okay, and then sell it at a very high price. So the difference between the prices, that's your buying price and your selling price, is the profits. And that's basically the idea the idea also in forex trading. Okay, that's basically how we make money in forex trading. So let's take this for example. Okay, we can see this is how to make money trading forex. Okay, so let's take this for example. Now I wake up today and then the conversion rate between dollar and euro is 2. Okay, so $1 or $1 give me 2 euros. Okay, and then I then buy $100 worth of euros. Okay, and then of which I will get 200 euros. Okay, because $1 is worth 2 euros today, and then when I buy $100, I will get 200 euros because of this present conversion rate. Okay, and then let's say I wake up a week later and I want to convert my euro to dollar. I want to convert my euro to dollar. I want to have back my dollar. I want to have my dollar back, and I just want to convert my euros, which I haven't used, to dollar. And remember, I now have 200 euros. And then I wake up today or 1 week later, and then I discovered that the conversion rate between dollar and euro is no longer 2. It's no longer $1 to 2 euros. It's now $1 to 1 euro. Okay, so it means the euro has gained value over the dollar. Okay, and then now remember, I now have 200 euros. So my 200 euros, when converted back to dollar, would give me $200. Okay, so you now see the sense in that. So because the conversion rate has now improved for euro, and then when I convert my euro back to dollar, I now get $200 instead of $100, which I initially bought. You remember, I bought $100 initially. Now now I've been able to make a profit of $100. That's comparing it to the $100 which I used in buying my euro initially. So because right now I have $200. So I've been able to make this profit by simply buying and selling at the right time, or at the best prices. So I bought euro when euro was cheap. Okay, when euro was down. Okay, that's when $1 equals to 2 euro. Okay, so euro was down. I bought $100 worth of euros to give me 200 euros, and when euro rose up, and I sold it to make a profit of $100. So right now I now have $200. So that's basically an example of how we make money trading forex. Now, of course, the changes between currency rates are usually not this big, not as big as this example we've just looked at, and these changes are usually very little, very minute. And for this reason, we use what we call leverage in forex trading. So we use leverage to be able to make substantial amount of money in forex trading. In fact, some people call the forex market the leveraged market. So this is what enables us to make more money, or plenty money, from little price changes. And just see leverage as you being allowed to buy more than you can actually buy with your money, or you being allowed to trade more than your money can actually trade in the forex market. Okay, so leverage is what helps us make money in forex trading, and this leverage is given to you by your broker. Different brokers have different amounts of leverage they give to their traders, and of course we are not looking at brokers in this video, neither are we looking at leverage. Okay, I'm just introducing you to the concept of leverage and also brokers. So we're going to be looking at these concepts more in-depthly in further lessons. but I just want you to understand or to have an idea of what the leverage is. Okay. And so forex trading has been around for a very long time. In fact, forex trading is centuries old. It dates back to as back as the Babylonian period, I guess, and that's how far forex trading dates back. However, modern forex trading began in the early 70s, and the forex market is a decentralized market. Okay, it's not controlled by a particular body. It's not controlled by a particular government. It's a decentralized market, so anybody can come in and participate and make money. So modern forex trading began in the 1970s, like I said earlier on, and actually we've seen forex trading evolve. Forex trading has evolved over time. The way people traded forex in the 1970s is not the way people treat forex today. And in the 21st century, technological advancements and the coming of internet have made things really easy. Okay, so from the comfort of their homes, from the comfort of their offices, people can partake in the forex market via the internet, of course with a computer or a phone and with internet access. And that's how technology has actually made things easy and also made trading forex easy. Okay, now we're going to be looking at the types of forex traders. So there are basically 4 types of forex traders. We have the scalpers, we have the day traders, we have the swing traders, and we have the position traders. So I'm just going to go and try to explain each of these types of forex traders for you to understand their characteristics and features. So for the scalpers are kind of short-term traders. They focus on entering positions in short time frames and holding them for very short periods, like seconds to minutes. Okay, that's basically what the scalpers do. They hold positions for very short times, short time durations for seconds to minutes. So this is in order for them to take advantage of very small market movements. So they enter multiple trades and try to take advantage of very small market movements in order to make profit. So we also have the day traders, and the day traders enter multiple trades also, but they can hold trades for longer periods of time within a day, and they tend to target even more profits than the scalpers, and they also tend to close all the trades or all their trades before the end of the day. So these are the characteristics of the day trader. And then the swing traders hold onto trades for longer than 1 day, okay, and perhaps for up to a couple of days or weeks. So they enter less trades but make more profits per trade, okay, because they stay longer in a single trade, unlike the scalpers, which enter multiple trades but stay for a very short time. Okay, and then the swing traders tend to ignore little market fluctuations and they aim at bigger profits. And then we have the position traders, and then these ones, they hold on to trades for longer periods than all other types of traders. They hold on to trades for several weeks to even years. Okay, and they are less interested in short-term price fluctuations and more concerned with long-term gains. So that's it about the 4 types of forex traders: the scalpers, the day traders, the swing traders, and position traders. And with this, we've come to the end of our lecture for today, or we've come to the end of this lecture, and we'll be learning about currency pairs in our next lecture. And hope to see you there. Bye. Hello and welcome back. In this lecture, we're going to be learning about currency pairs in forex trading. So what are currency pairs? What are currency pairs? So a currency pair is basically a quote of one currency against another currency. So this is a form of comparison between two currencies. Okay, so in the forex market or in forex trading, we don't just trade one currency. We don't just buy one currency or sell one currency randomly like that. Okay, what we do is we compare two currencies. So if we are buying a dollar, we will have to buy dollar against another currency. So we have different currency pairs. Okay, so let's say for example, this is Euro USD. Okay, sorry, this is euro USD. Now this is euro against dollar, so we are comparing euro against dollar. So if we are buying dollar, we're going to be saying that dollar is going to gain value against the euro. Okay, that's if you are buying euro USD, or okay, if we are selling euro USD. So this is an example of a currency pair. There are hundreds of currency pairs or thousands of currency pairs in forex trading. So these are examples of currency pairs. This is euro USD. Okay, that's euro against the dollar, and then this is GBP USD. That's Great Britain pound against the US dollar. We have the USD CAD. This is the US dollar, US dollars against the Canadian dollars. We have the euro AUD. That's euro against the Australian dollar. We have the GBP NZD or NZD. That's the Great British pound against the New Zealand dollar, and we have a lot more currencies. Okay, so the idea of currency pair, like I said, is the comparison between one currency and another currency. Okay, so we are basically saying one currency is going to gain value against the other currency. So when we are saying this currency will gain value, we're actually buying that currency. If we're saying this currency will fall, okay, we're actually selling that currency. So that's the idea of currency pairs. Okay, so we have what we call the base currency. So the base currency is the first currency listed. It is always one. So the first currency listed, in this case euro USD, euro will be the base currency. In this case GBP will be the base currency. In this case USD will be the base currency. That's USD stroke CAD. And in this case euro will be the base currency, and it is always equal to 1. And then we have the quote currency. Now this is the second currency listed, okay, and it is the exchange rate between the base currency and the quote currency. Okay, so this is the quote currency in this case, which is the second currency listed, and this is the quote currency in this case. Okay, GBP USD, and USD is the quote currency because it's the second currency listed. In this case we have CAD as a quote currency. In this case we have AUD as a quote currency, and in this case we have NZD as the quote currency. So that's the idea of base currency and the quote currency. And the value of the base currency is always 1. The value of the quote currency is now the exchange rate between the base currency and the quote currency. I don't know if you understand, but I'm very sure you're going to understand in subsequent videos, because we are going to work with these metrics very easily, okay, and very frequently. So that's just the idea of the base currency and the quote currency. And you might be wondering, why do we name our currencies with these codes? Okay, with this, will I say, yeah, with these codes like EUR for euro and USD for US dollars. And we see that these codes are always 3 characters. So this is what we call the ISO code. So the ISO stands for International Organization of Standardization. So each currency in the world can be identified by a 3-letter code known as its ISO code. Okay, and then if we come here, we see that I've listed some ISO codes of some major currencies, like the US dollar, which is euro, which is USD rather, and then the euro, which is EUR, the GBP pound, which is GBP, and with the New Zealand dollar, which is NZD, the Canadian dollar, which is CAD, the Australian dollar, which is AUD, the Japanese yen, which is JPY, the Singaporean dollar, which is SGD, the Swiss franc, which is CHF, and this Chinese yuan, which is CNY. So these are just the ISO codes of some major currencies. Now you can just Google ISO codes of any currency you want, and you're going to get the ISO code of that currency. It's online. It's something you can access very easily. Okay, so for a recap, you should just know that we have 2 currencies in a currency pair. Okay, when we trade the currency pair. We don't trade a single currency in isolation. We trade a currency pair. So in this case, we have euro USD, GBP USD. So euro is the base currency and USD is a quote currency. And then euro is always equal to 1, in this case, and then USD would then be the conversion rate between euro and dollar. So that's it, guys, for the currency pairs. And in the next video, we're going to be looking deeper into currency pairs. Okay, and hope to see you there. Bye. Hello everyone and welcome back. In the previous lecture, we spoke about currency pairs. We learned about what currency pairs are. Now, in this lecture, we're going to be looking at the categories of currency pairs. Okay, so we're going to be looking at how they are categorized. Okay, so in Forex, we have a way we categorize the currency pairs. Okay, and that's what we're going to be learning in this video. So I have this this on my screen right now, and it says most traded currencies. So these currencies are the most traded currencies and most popular currencies globally. So we have a list of currencies here with the countries or the regions they are associated with, and with also this percentage value. Okay, now this is the percentage of how much this currency is used for global trade. Okay, for global trade. So we see that the US dollar is the most used currency globally for trade. We have the US dollar at 44.15%. We have the euro at 16.14%. We have the Japanese yen at 8.4%. Okay, we have the Great Britain pound at 6.4%. We have the Australian dollar at 3.38%. Okay, that's percentage of global trade. Okay, and then we have the Canadian dollar 2.52%, Swiss franc 2.48%, and then we have other currency pairs. Other currencies rather, not currency pairs. We have other currencies. Now these other currencies comprise of all the other currencies in the world. Okay, all the other currencies in the world. They just make up 16.53% of global trade. Now, of course, in this section we have the countries these currencies are associated with. We see that the US dollars is associated with the US, or with the United States of America. The euro rather is associated with the European Union. The Japanese yen with Japan. Then the Great Britain pound with the United Kingdom. Australian dollar with Australia, and then Canadian dollars with Canada, and Swiss franc with Switzerland and other countries. So these are the most traded currencies globally. So this is something you should note. Then in the next slide here, we have the most traded currency pairs. Now these currency pairs are the most traded currency pairs globally. These are the most traded currency pairs globally. So here we see that we have the currency pairs here, and then we have the percentage of global trade in the Forex market. So we have the Euro USD at 28% of trade. Okay, we have the USD JPY, that's United States dollar against against the JPY or the Japanese yen. We have this at 13%. We have the GBP USD, which is the Great Britain pound against the US dollar at 11%. We have the AUD USD at 6%. We have the USD CAD at 5%. We have the USD CHF at 5% also. We have NZD USD at 4%. We have Euro JPY at 4%. GBP JPY at 4%. Euro GBP at 3%. AUD JPY at 3%. And Euro AUD at 2%. We have others also. We have others at 12%. That's other currency pairs at 12%. Like I said, we have thousands of currency pairs, but these are the major currency pairs. Okay. So the next trade we have the okay, and then you have to note that these are what we call the major currency pairs. Okay, we have the major currency pairs, and then we have the cross pairs. So major currency pairs are basically currency pairs that have the US dollar in them. So we can see that all currency pairs here, okay, not all, but most of them here have the US dollar in them. So these are called the major currency pairs in Forex trading. Okay, and then we even have the cross pairs. Now these cross pairs are currency pairs that do not include the US dollar. So examples are GBP, JPY, GBP NZD, AED, SGD, and ETC. So we can see some of them here also. We can see we can see Euro JPY, we can see GBP JPY, and we can also see these other ones. So these are examples of cross pairs. So we have the major currency pairs, we have the major pairs, which are the pairs that have US dollar in them, and we have the cross pairs, that's the pairs that do not have the US dollar in them. So these are them, and that's it for this lecture. Just to introduce you or to enlighten you more about the categories of currency pairs. So for the categories of currency pair, to recap, we have the major currency pairs, then we have the cross pairs. The major currency pairs are currency pairs with the US dollar in them, just like we have the GBP USD or Euro USD. So these are examples of major currency pairs. Then we have the cross pairs, which are pairs without the US dollar in them, like the ones you can see on your screen right now. Just note that these slides will be made available to you, so you can also study on your own in case it will make your learning process more delightful or more peaceful. So that's it for this video, guys. Thanks for staying tuned and hope to see you in the next video. Bye. Hello everyone and welcome back. In this lecture, we're going to be learning about sessions in Forex trading. So to the question now, what's a session or what are sessions in Forex trading? So I'll define session or I'll define a session as a period of time where traders in a particular geographical location tend to trade the market or tend to be active more trading the market. So even though the Forex market runs for 24 hours in a day, you have to understand that all major markets in different parts of the world have their particular or have their peculiar timing. Okay, and their timing is what sessions in Forex is all about. So it's basically a timing. It's basically a time period where traders in a particular region tend to be more active. Okay, so the Forex market can be broken into 4 or 5 major sessions. That's in relation with the 4 major markets in the world. So we have 4 major markets in the world, and the sessions can be broken down into 4 major sessions based on these major markets in the world, or that's the major Forex markets. Okay, so one important thing you need to note is that the peak trading hours or most active trading hours are usually experienced in periods of intersections between different sessions. Okay, and during a currency session, that currency tends to be stronger. Okay, that currency tends to be stronger because that currency or that country rather or region's economy is most active at that period. So this is, however, not always the case, as this is also subjected to fundamental and technical analysis. I'm sure you don't know about fundamental or technical analysis, but it's something we're going to look at in further lesson. We have 4 major Forex market sessions, and these are the Sydney session, which is related to the Australia, with Australia. And then we have the Tokyo session, which is related to Japan, okay, or Asia. And then we have the London session, which is related to England. And then we have the New York session, which is related to the United States of America. So these sessions have currencies which they favor, okay? So look at the New York session, for example. The New York session obviously will favor a currency like the US dollar, and it also favor a currency like the Canadian dollar, because the United States and Canada are kind of closer geographically. So you tend to see that their currencies tend to behave alike because of their proximity geographically. Now, because of the geographical proximity between these two countries, that's the US and the US and Canada, we tend to see that their economies tend to be active at around the same time. Okay, that's why this session, which is the New York session, tends to affect the US dollar and also CAD. Now, the London session tends to affect the Great Britain pound. Okay, but we also see that the London session usually affects the euro also, because they are kind of located geographically close to each other because they are all in Europe. Okay, they are all in Europe, and they kind of behave alike also. Now we see that the Tokyo session, which is Japan, tends to favor the Japanese yen. Okay, and then probably some other currencies or some other countries that are close in proximity to Japan will also enjoy the favors that come with the Tokyo session. And then the Australia, or the Sydney session rather, tends to favor Australia. Okay, and we see currencies like the Australian dollar and then also the New Zealand dollar also tend to behave alike because of the Sydney session. Now in the next slide, I have this little illustration that illustrates the forex sessions all across the world and relating them, of course, to the time zones. Okay, we have the GMT here, we have the EST, we have the CST, MST, PST, and West African time, that WAT. So these are the time zones, and from wherever you are in the world, you probably fall under one of these time zones. So you can actually relate the forex sessions, okay, to your country's time. So we can see that for New Zealand, it opens at 21 GMT and then closes at 3 GMT. Then we have the Australian session, which opens at 23 GMT and then closes at 7 GMT. So you see that this is just about 2 hours difference. Okay, we have the Tokyo session, which opens at 0 GMT and then closes at 7 GMT. We have the London session, which opens at 7 GMT and then closes at 16 GMT. We have the New York session, which opens at 12 GMT and then closes at 20 GMT. So that's the idea of GMT. Sorry, that's the idea of sessions in relation to geographical locations and also the time zones we have. So like I said earlier before, I said one important thing for you to notice that the peak trading hours or most active trading hours are usually experienced in periods of intersection between different sessions. Okay, and during a currency session, that currency tends to be stronger because that country or region's economy is most active. Okay, so let's just focus on this first part of the statement. So the peak hours or the most active trading hours are experienced during the periods of intersection between different sessions. So when I come to this slide right now, you can see that from here to here, like this, if you can see from here to here, we have a gray color, we have a gray background, unlike this part which is white. Okay, and we also have the same thing happening here. So I've created this to show an intersection between different sessions. So we have the London and New York session intersecting at this point. We have the Australian session, the Tokyo session, and then parts of the London session intersecting at this point. Okay, so we tend to see that these points are kind of the peak hours or the most active trading hours in these sessions, because more traders are trading in this intersection. Okay, we see that traders here, and traders here are trading in this section, but from here to here, we will have traders in the New Zealand. Okay, and of course here also will be more active. The most active intersection will be this point. You see where my mouse is pointing at, this point, because it's at this point that we have all of these players present. Okay, so that's the idea of sessions. So these files will also be available, or this file will also be available to you, so as to follow along and so as to see for yourself. And this will also guide you as you learn how to actually go about your journey as a forex trader. So thanks for staying tuned, and hope to see you in the next video. Bye. Hello guys, and welcome back to the course. In this video, we're going to be learning about the forex market players. So the forex market players are the people that play in the forex market, the people that are involved in the forex market. So first of all, I want us to look at what is known as the interbank market. Okay, so the interbank market is a global network used by huge financial institutions to trade currencies directly between themselves. Okay, so they trade at this level using either of two brokering platforms, which are the EBS or electronic brokering service and the Thomson routers. So the interbank market is only available to the biggest financial institutions, and these are just a few of them. These financial institutions, because of the size of their trades or because of the size of the money they trade with, they account for about 60 to 80% of the volume of trade in the forex market. Okay, so they trade with billions and billions of dollars. So the interbank market is used only by the biggest banks, which are also known as the flow monsters. So this is a nickname for these banks, these big banks. They are also known as the flow monsters. So this is because of the size of trades they take or the money available to them. They enter trades with billions of dollars. So these huge banks are the Banks of America, the HSBC, Citi, JP Morgan, UBS, Barclays, the Deutsche Bank, and Goldman Sachs. So these are the banks I am talking about. They are the biggest banks, okay? The biggest banks. So they are the ones that trade using the interbank market, okay? And this market is just a market between them, between these big banks. So small traders like us, like me and you, are not even close to this level, okay? So we are not even close to this level. We are down the food chain. So these are the big boys. These are the biggest boys at the top of the food chain. Okay, so that's one thing you have to note. Now I'm going to go to the next slide. Now this next slide shows you a pyramid. Okay, like a food chain or food pyramid, showing you the dealers or the forex market players, like I said before. So we have the dealers here. So these are the FX dealers. So these are the ones we just looked at, the huge banks, okay, or the flow monsters. We call them the dealers or the FX dealers or the forex dealers. So these are the ones that trade using the interbank market. And then we have large financial institutions. So after the dealers, we have large financial institutions. Now these financial institutions include central banks, include commercial banks, include hedge funds, include government institutions, include businesses, okay, businesses that trade forex. So these are financial institutions. So they themselves cannot partake in the interbank market because their money is not big enough. So they tend to go through one of these big players. Okay, one of these big players. They tend to gather their order and then go through one of these big players to be able to partake in the forex market. Then lower on the food chain or lower on the chain or on the pyramid, we have the brokers and the retail ECNs. So these are the brokers. Like I said in one of our earlier videos, I introduced you to a broker basically, but that's not a proper introduction. We're going to do a proper introduction in further lessons. But yeah, this is the broker. So the broker is basically the company that helps you execute your trades. So the broker connects you to the forex market. Okay, so we have them at this point, and then finally we have the small retail traders. So we are the small retail traders. Yeah, so we are lower on the pyramid, and we need brokers to help us execute our trades, to help us connect us with the market. Yeah, so this is the chain, or this is the pyramid of players in the forex market. In further lessons, we're going to be looking more into brokers, and then how to choose brokers, how to choose the right brokers, because not all brokers have your interest at heart. Some of them will just want to make profits off you, and you have to be wise. You have to choose brokers that will treat you well. So I'm going to guide you through how to choose the best brokers, and I'm also going to recommend the brokers I use, okay, which I think will do you good. That's in further lessons to come. And with this, we've come to the end of this lecture on the Forex market players. Hope to see you in the next. Bye.